All right, good morning. Trust you are doing well. We want to focus on IS2, a standard for inventory. IS2 inventory. And as usual, what we do is to define it. So let's talk about the definition. Now, what is inventory? When we are talking about inventory, then we are basically talking about the assets that the entity sells in the ordinary course of activity. All right, so we are looking at those ones. So one, the assets and assets entity sells. The assets that the entity sells. In their ordinary course of activity. So activity. So that is one, and this we normally what they sell will be what? Finished goods. But not only that, we are also talking about, when we talk about inventory, we also talk about assets in the production process. All right. In the production process for sale, also in the ordinary course of activity. And this is what we call work in progress. Then we also talk about the materials and supplies that are consumed in the production process. That are consumed in the production process. And this we call what? Raw material. So all these things are inventory. So wherever you find them, they are inventory. All right. That is it. Now, of course, this is inventory, and if you want to recognize inventory, then we are kind of looking at it's an asset. So you using the asset or you selling the asset will bring you economic benefit, and you being able to actually calculate the cost is also a recognition criteria. So as assets, there are some things that basically stands out as recognition criteria. Well, we are going to focus on how to measure it, how to measure the inventory. So we talk about measurement. So the measurement always, as we do, we look at the initial measurement. Then later we look at the subsequent measurement. When it comes to inventory, initial measurement is at cost. At cost. All right, so cost. And don't forget the elements of cost. Whenever we mention cost, cost comprises of one, we talk about the purchase price. All right, the purchase cost of the thing or the price of the thing, less what? Discounts and rebates. And please, the discounts that we are referring to here, all right, trade discounts and any rebates. All right, so that is that. We also talk about direct costs. Direct costs such as transport costs. Because when you bring the thing in, okay, handling costs, and others that may be. And lastly, we talk about conversion cost. Conversion cost, I mean, you need your prime cost. I mean, you are producing the thing, so you need prime cost. You will need what? Some portions of overheads. All right. So we talk about variable overheads. All right. Yeah. So that is that. Production overheads. So that is that. And these things should be based on the normal level of what? Activity. The sharing of the overheads, as you can see, is always based on what? Normal level of activity. All right. So if you want to get the cost of the thing, these are the things you combine. Of course, yeah, we will look at the mathematical examples for you to see. All right. So now, what you need to understand is that in determining this cost has been established here, there are important notes you have to take note of. We don't add abnormal loss as a cost. Abnormal loss is not added. Storage cost is not part of the cost of an inventory. Please take note of that. It's not part of the cost of an inventory. Administrative overheads, all right, which does not contribute directly to bring the inventory into its location, are also what? Not part. Selling costs are not part of the cost of the asset. So all these things are expensed in the P&L, not capitalized. They are expensed, not capitalized. Please take note of that. So that is what you need to understand about the initial measurements. All right. Of course, if you are valuing your inventory, if you want to value your inventory, we said, like, in terms of recognition, cost must be reliably measured. All right. So the valuation methods you can use are: one, the actual unit cost. The actual unit cost. And we use the actual unit cost for inventory that are not ordinarily interchangeable. So you use this one for non-inventory that are not interchangeable. Not interchangeable inventory. So that is, for example, used cars. You can't buy somebody's used car and come and say, please, I want to interchange it. I finished using it. I want another one. You can't do that. Then we have FIFO and what? Weighted average. Please, LIFO is not allowed in IES2. LIFO is not accepted. So you use these ones for inventories that are ordinarily interchangeable. All right. So that is that. That is that. So please be careful. And please, what you should understand is that you cannot be changing the valuation methods, okay, unless it gives what? Faithful representation, unless it's allowed by the standard. So these are things that you need to actually take note of. All right, then let's talk about the subsequent measurement, because that is where the issue always is, the subsequent measurement. All right, subsequent measurement. All right, so the subsequent measurement. Now, subsequently, the inventory is measured at what? The lower of cost. So the lower of cost and net realizable value. The lower of cost and what? Net realizable value. Of course, you know what cost is. We've discussed what cost is. All right. Yeah. So what about the net realizable value? You need the net realizable value. Now, talking about the net realizable value is actually the proceeds you get from selling, proceeds from sale, from selling the asset, minus completion or selling cost. So you hear something like fair value less cost what to sell, less cost to sell. All right, so that is that. Do that of the net realizable value, all right, on line by line basis for each inventory. Okay, so that is that. That is that. Or you can group items that are sold together in one same market, and you do that, you determine their fair value less cost to sell. So basically, that is what you need to know. All right. That is what you need to know. But it is said that in determining the net realizable value, it should be evidenced by what? A sales contract. A sales contract. So there has to be what? A contract. So that is that. That is that. All right. Okay, so let's pick some example point of these things out. Number one. So some example points. All right. The first example point is that the net realizable value can be estimated. All right, it can be estimated. All right, so even though you don't have it there, the estimate may be given to you in the question. All right, so that is that. Number two, example point number two is that the sale after the reporting date, I mean, provided there is let's say 31st December and there is a sale after the reporting date, providing an evidence about the inventory that was seated at the reporting date. All right, is showing you an adjusting event. So what do I mean? I'm saying that if you sell the inventory, so sale after the reporting date, all right, before financial statements are authorized for issue, before the financial statements are what issued, that sale after the reporting date provides evidence about its net realizable value. Its realizable value at the reporting date. At the reporting date. What do we mean by that? If you know your IAS 10, all that I'm trying to tell you is that this, if this happens, it's an adjusting event. It's an adjusting event. So it means you have to use the lower of cost and what? Net realizable value. All right. So that is that. That is that. Okay. Exam key number 3. Exam key number 3. Exam key number 3 is that if the net realizable value is lower than the cost, then it means what? Impairment has occurred. Impairment has occurred. And therefore, you need to talk about impairment. All right, so that is that. Then the last one, because we are going to pick up exam questions and look at them now. All right, we are going to look at them. This one is very, very important. Raw materials are not written down. Are not written down below cost. Below cost. If the finished goods, FG, all right, the finished good they have will form parts of the goods that will be sold at a profit. So you can't write the raw materials down. If the finished goods, all right, they form parts. If the finished goods that the raw material will form part. So if the finished goods that the raw materials form parts will be sold, part will be sold for a profit. Okay, so that is that. This is very, very important. So if you know that the finished goods that the raw material who is forming part, I mean, you are using the raw material to get the finished goods, okay? So if the raw material that you are using to get the finished goods, and at the end of the day, the finished goods will be sold at the profit, you cannot say the raw material has been impaired. So long as the raw material forms part of the finished goods that will be sold at the profit, that raw material cannot be written down. All right. So that is that. Because if the raw material decline, it means that the net realizable value has fallen to the purchase cost. Okay, so take note of that. So if the raw materials decline, it means the NRV we are looking at has fallen to be purchase cost. Take note of that. All right. So if the raw material, let's say the raw material prices decline, then it means that the net realizable value has fallen to the purchase cost. So in such a case, in this case, what will happen is that replacement cost of the raw material provides the NRV. That will be the replacement cost will be the NRV. All right, so ladies and gentlemen, that is that. Understand these things. We are now going to pick up the questions and go into it. Quick one, very, very short questions. All right, so let's have the questions and deal with it. All right, so all these things are in the corporate reporting manual and FR manual. So if you need one, you just contact me. You can use this number to contact me to get a copy of the book. All right, so that is that. Now let's look at the questions, these interesting questions coming from FR. So we are told that Esinam Limited has the following products in inventory. Don't forget, when we talk about inventory, talk of three things: finished goods, what, work in progress, and what, raw materials. Good. Then, so we are told Esinam has this. Ahumka completed. This is the number and this is the price. Then Adonko part completed, so work in progress. So it is allowed for us to capture it under what? Inventory. All right. Each product normally sells at 34. Due to the difficult trading condition, Esinam Limited intends to offer a 15% discount per unit and expect to incur 4 cedis per unit in selling what costs. Then he also 10 cedis per unit is expected to be incurred to complete each of what each of Adonko. So that one is specifically to Adonko. In accordance with IAS2, what should be the inventory amount to be stated in what? The financial statement. What do we need? If you are talking about the financial statement, then what we need is a subsequent measurement. All right. If that is it, we need a subsequent measurement. So in that case, we need two things. So solution one, we will need two things. What are the two things we will need? We will need the cost, and we will also need what? The net realizable value. So those are the two things we will need. Now let's look at these things. So we are told that the cost, we have ahumka. Remember, we said that you have to separate them. We don't put them together. So we have ahumka and what? Adonko. The unit we have 5,400, then we have 2,800. So the cost is that this one is at what? 22, and this one is at what? 26. So we will multiply and see how much we will get. You can do that. So this one will give you 118,000 what? 800. And we have 2,800 multiplying 26. And that gives me 72,800. So this is the inventory that we have at cost. What about the net realizable value? Of course, the quantity, so let's divide here. The quantity is still the same, but the price. So that is, you have this, but the pricing here is something, there's something you have to check. We said that, what do you call it? You need net realizable value. It can be estimated. So we said you need the selling. So what is the selling? The selling is what? They can sell it, they normally sell it at 34. But that 34, before they can do that 34, what will happen? They will have to give a discount. So it means that this 34 has to suffer a discount. So if you do a discount of 15%, which means that the 34, we can only apply what? 0.85, because we are giving out a discount of 15. So that is that. So as far as the 34 is concerned, we need to reduce the 34 by a discount of 15%. So that we can't sell it at 34, we have to reduce it so by what? 0.85. All right. Then again, it says that they will incur 4 cedis. So after that, we need to also deduct 4 cedis out of it. All right. So that is for the product. Now, that said, which means that if you do, let's say 0.85 multiplied by 34, I think what you get is 28.9. Then you less 4. That one will give you 24.9. So if you now multiply it by the 5,400, the amount you are getting will be somewhere around 134,460. So that is what it will be. All right. So since we want the lower of cost and net realizable value, if we are comparing these two, of course, which one will we pick? Obviously, this. Then we do same. This one too is at what? Yeah, 34. They also sell at a discount, and also -4, but again -10, because we are told that for that one they will have to spend another 10. And that in 10, if you do that, you will get 14.9. 14.9. And if you multiply the 14.9 by 2,800, what you'll be getting is 41,720. So that is it. So this one too, the lower that we will pick will be what? This one. So in terms of our picking, we will have ahumka. What you go to our financial statement, you have ahumka, which is 118,800. Then we have adonko, which is how much? 100. This one is 41,720. So that is it. So in total, we will have, you add this one, 118,800. We have 160,520. So basically, that is how you find. So the question is ask you how much will be stated in the financial statement. This is it. But you see, the cost, total cost here, how much would it have been? So we have 118,800 plus 72,800, right? That gives us what? 191,600. So what will happen is that for a 191,600, moving now to 160,520 tells you that we need to impair this one by an amount of 31,080. All right, we need to impair this one, the cost. So if you remember in the principle, we said that when so if you remember, this is it. When the net realizable value is lower than the cost, impairment as what? Okay. So that what will happen is that this figure we have here will go to our SOFP balance sheet. All right. Then the impairment you are having here will now go to your what? SPL. All right. That is it. So that is what will happen. Okay. The SPL, the party to go is the cost of sales. You are adding it to cost of sales. All right. So ladies and gentlemen, that is how you work it. All right. Let's pick another question. Which is also tested in financial reporting. We have Saboba, and Saboba manufacture plastic water tanks and for farming industry. On 31st May 2018, its closing inventory was consisted of 950 kg of plastic resin raw material and also 250 of finished goods plastic water tanks. Further information are provided as we have. Now, plastic, the purchase price of plastic resin is 3. Okay, we have a purchase price. Okay, good for us. Then they said it's 3 per kilogram throughout the year to 31st. So we can get the number of kilogram. We have 3 here. Plus an additional 0.50 per kg delivery cost. You remember, transportation cost is part of it. Saboba has a policy of always keeping plenty of the plastic resin in inventory. As its supply has been what? Unreliable. However, close to the end of the year, the price of plastic resin reduced. So if it reduced due to supply exceeding demand, the purchase price of Saboba's raw material is now 210 plus 0.50 kg in delivery cost. The existing inventory of plastic can be sold at 1.80 net of all costs. All right, so we will look at the plastic, then we come and look at what the tanks. The tanks too, it says that each tank requires 10 kg of plastic, and each unit incurs 25 cedis in conversion cost. That's labor and overhead. Saboba sells the tank at 100. It is expected that this price will drop to 90 as a result of the fall in the market price of plastic. All completed units sold by Saboba incur 6 selling and distribution cost. All right. So we have all this information, but the question said that calculate the value of the inventory in the books of Saboba, applying the principles of IAS 2. So if that is the case, we will need 2 things. We will need cost. We will need net realizable value. Now, what will happen? What will happen is that let's find our cost. So we are going to talk about plastics. And as we are done, when we are done with plastic, we will now look at the other one, which is what? The tanks. All right. So we are told that the raw material in terms of the plastic, how much are we getting? Raw material. The raw material cost per unit is 3, right? Then additional cost in terms of delivery is 0.50. So it means that we have cost of 3.50. So that is what we have. That is what we have. Then let's look at the net realizable value. The net realizable value. How much can we sell the thing? So the expected sale, we are told that they can sell it at 1.8 net of what all costs to expected sale. So it means that what you need to focus here is that we have two inventories here. Two inventories. It says that, so we were giving the first information up to the point. So however, at close to the end of the year, the price of the plastic resins is reduced. The purchase price is of raw material. So there is a raw material part. Don't forget, inventory consists of what? Raw material and what? Finished goods. So the expected sale, we have the raw material component, and we also have what? The finished goods component. So let's look at the expected sale for the finished goods component. So expected sale. Don't forget, when we say inventory, it's comprised of raw material, finished goods, and what? Work in progress. Now, the expected sales for the finished goods, we are told that the selling price net of all the cost is going to be how much? 1.8. 1.80. So that is what we have there. That is what we have. All right. So that said, we also have something about the raw materials that you have in there. That we have in there. All right. So how will we go about it? We are also told here that the raw material we have here is going to go for my pen frozen. Wow. Just a minute. And the value of the raw material, we are now told that the raw material is at what? 2.1 cost 2.10. Then delivery, so cost per unit, delivery is how much? 0.50. That gives us what? 2.60. So that is that. So don't forget here, the quantity we are looking at is what? 950, right? The quantity here is also 950. So let's do the multiplication. So if you do 950 multiplied by 3.5, what do we have? So 950 by 3.5, we have 3325. All right. Then when you come here, so you have 950 by 1.8. What will we have? That it. So we have, yeah, closing inventory consists of this. All right. So that is that. Then the raw material, that one to something that was 3, you could see that is now 2.6. That is it. So we have 2.6 here. All right. So that is what we have there. So this is the raw material. So you could see that what we discussed about this point. Look at this point. So you have a raw material in this, in here. So first of all, let me show you something. You have 950 multiplied by 1.8, which is what? 1710. All right, that is down. Remember this point that we made, and it's very, very important that you get the understanding of these things, that raw material are not written down below their cost. If the finished goods of the if the finished good that that raw material form part will be sold what? At the profit. If the raw material declines, it means that the net realizable value have fallen to be what? The purchase cost. in this case, the replacement cost of the raw material provides what? The NRV. So if you are going to replace the raw material, so this is it. The raw material is equal to what? The purchase. Okay, let me go back for you to see. These are principles people elude. All right. So raw materials are not written down below cost. They are not written down below cost. If the finished goods that raw material will be sold at will be at a profit. So it's a principle we need to go back and put in that question. Now, so if the raw material declines, then it means that the net realizable value has fallen to be purchase cost. So you see that what we see there, the one that has fallen will be the purchase. In this case, the replacement of the raw material provides what? The net realizable what? Value. So if you are now going to replace those raw materials, the question told you that they had some raw materials. Now, because they have not used it, the values of the raw materials are falling. We don't have a problem with that. The inventory has fallen. We don't have a problem with that. Now, the raw material aspect, you saw that the finished good, they said if they can sell everything at 1.80. So the raw material aspect, you could see that the raw materials that probably they have is coming down. So if this happens, it means that the net realizable value we are looking at has fallen to be the purchase cost. In that case, the replacement cost of raw material provides what? The net realizable value. So this one, when we say a replacement cost, it's not about you going to sell and find out how much it will be. It is about, okay, right now, if you are supposed to replace that raw material, how much will it cost us? So we are not selling. We are actually what? How much will it cost us to replace? Now, so coming back to the question here, how much will it cost us to replace the raw material? The quantity of the raw material is going to be what? 2.1 and what? 0.5. And that, the quantity, if you do the multiplication, let's see, it will be what? 2.6 by 950. If you are replacing it, that gives me some like 2470. If I add these two up now, I hope it is 2.6. Yes, 2.6. So 2.1 and 0. Yeah. So you have, if I get this one now, so I'm having 2.6, 2470 plus 1710. So in total, I have something like what? 4180. So this is it. In this case, I'm comparing these two things. Which one do you think I will select? Obviously, it will be what? 3325. So for when it comes to the plastic, that is our picking. Then let's go to the tanks. What is the cost of the tanks? We are told that cost require 10 kg of plastic to manufacture. A 10 kg of to manufacture. Okay, so 10 kg. What is the price of a kg? The price of a kg we are told here is 3 throughout the year. So if you need 10 kg, multiplying it by 3, then it means you have what? 30. All right. Then we are also told that and each unit will incur 25 conversion costs. We know conversion cost is part of the cost of the asset. So we have conversion cost, which is 25, not 20, 25. So that is the cost. So we have 55. And what is the quantity we are looking at here? The quantity is what? 250. So if I put my 250, what are we getting? So we have 55 by 250, which gives me 13,750. Very, very cool. Then what about the net realizable value? It said that Sabuba sells tank for 100. It is expected that the price will now drop to what? 90. All right. So apart from the 90, we are also told that it will incur a 6 cedis what? Selling and distribution. So it means that the selling, the fair value or the realizable selling won't be the 100. It will be what? The 90. Selling price to be 90. Then we need to also less a 6 of what? Distribution. So we have 84. So 84 by 250, what are we getting? So 84 by 250. That gives me 21,000. So which one is the lower that we will pick? Is obviously this. So it means that in the end, the inventory value to the SOFP is going to be how much? We have the first one, the plastics. We have 3325. Then we have the tanks. The selected one is 13,750. So we have 13,750 plus 3325. Then we have 17,075. So this is what is going to our balance sheet. Now, if you want to do any concept of impairment, it means you need to look at the cost aspects. This is the cost 3325, and this is it. So we pick the cost, so there is no need for impairments. I mean, we didn't pick the net realizable values. The impairments were the answers. All right. So let's look at a more discursive question, the last question, which is a more discursive question. These are the ones that corporate reporting is like. All right. The question says, Phil is a coal mining company and sells its coal on the spot and future markets. Interesting. On the spot market, the commodity is traded for immediate delivery, and on the forward market, the commodity is traded for future delivery. The inventory is divided into different grades of coal. One of the categories included in the inventory at 30th November 2016 is a coal with low carbon content, which is of a low quality. Phil will not process this low quality coal until the other coal has been extracted from the mine. It means they will be keeping it. All right, which is likely to be in 3 years' time. Interesting. Based on the market information, Phil has calculated the 3-year forecast price of coal will be 20% lower than the current price. The directors of Phil would like to know on 2 matters: whether the conceptual framework affects the valuation of inventory, how to calculate the net realizable value of the coal inventory, including the low quality coal. Advise the directors of Phil how the above transaction will be dealt with in the financial statement with reference to IFRS and what conceptual framework. And it's a 7-mark question. So how do you go about explaining it? So let's first pick the first matter. The first matter is what? About the conceptual framework. What has conceptual framework got to do about this? Of course, if you remember your conceptual framework, remember we talk about measurement criteria, measurement. And the measurement, it looks at what? Historical and current. And under the current, you remember we have fair value. You remember we have what? Value in use. And you remember we have what? What we call current value, current cost, which can be the replacement. And if the thing is going into liquidation, it is what? Realizable value, the net realizable value. So this is what conceptual framework gives us. Now, what we are actually talking about is, so this is historical cost and current value, all right? So that is what the conceptual framework gives us. Now, the net realizable value is this one. So it is part of the measurement of what? Current value. So you have to understand that. However, the conceptual framework is not an accounting standard. All right. And so it says that when there is a trade-off between a standard and the conceptual framework, which one should prevail? If you know your conceptual framework now, you know that the standard what prevails. since there is a standard embodied in it. So you tell the examiner that the conceptual framework will not affect it, the valuation of the inventory. It must be referred to what? IAS2. All right, it must be referred to IAS2 because inventory is governed by IAS2. So conceptual framework trade off with the inventory standard. You have to leave it for the IAS2 to be used to measure the concept. All right, so that is the I. Then the II, we are now looking at how to measure the net realizable value. So we are going to do the net realizable measurement under what? IAS2. So now we know that the IAS2 defines the net realizable value as what? The selling cost, the selling price that you get, all right? Then you have to let any cost of completion and any cost of sales. Do you remember? Yes. So if you remember, I showed you here. I showed you, that is when we started explaining the concept. We put it somewhere here. All right, so the selling, the proceeds from selling, all right, and you will less what? Minus completion cost and what? Selling cost. So that is what, and you, at the end of the day, the lower of cost and net realizable value will be the one that will be placed in the financial statement. So the net realizable value also, we also learned that it can be what? Estimated. So these are the things you are telling the examiner, it must be estimated. So it means that what will happen, as you can see, they are giving you some things about the market, and so it should help you do your estimation. So at the end of the year, the spot price will give a good evidence on the net realizable value. The spot price at the end of the year will actually give you the evidence of the net realizable value. All right, so that is what will happen for you, and you have to execute a contract, because if you we said that, and I think I mentioned it here, that it has to come via what? A contract. It should be evidenced by a sales contract. So if you are going to do the thing at sell it at a future date, there has to be what? A selling contract for you to be able to go ahead and do that. All right, so that is that. So if there is no selling contract, then we are now looking at something under IFRS 9. Yes, or IAS 37, a onerous contract. So that will be provisions or a onerous contract. So the thing is that in this case, a financial instrument is not applicable, and also a onerous contract is also what? Not applicable, because this thing is what? An inventory. So therefore, what you are going to do is that you are going to calculate your net realizable value of the low carbon using what? A forecast market price. Forecast market price. That is what you are going to do. Don't forget, we said that it can be estimated. And so you are going to do the net realizable value using a forecast market price, especially for the low quality coal. So you use a forecast to actually determine the net realizable value. Then what will happen is that future changes in the forecast market price, especially for the low carbon, will require you to make some adjustments. So every year you have to make some adjustments. So if the prices are changing, then that is it. But you see, the first thing you must talk about is definition of net realizable value. It's a 7-mark question. Understand the process from selling minus the completion cost and what cost to sell it. All right, so that is that. You put that one down. Then you try and find out if there is any other standards applicable to this. This is inventory, so you are going to basically stay in your IAS2. And it is said that this net realizable value can be what? Estimated. So you are going to estimate it using the future forecast. Then what you should understand is that you are going to always look at the value at the end of each reporting period. Whichever the net realizable value, you have to look at it at the end of each reporting period. So if the forecast changes, there's anything that will cause the forecast to change, then it means that you have to make an adjustment, and that adjustment is coming, it will be see, this thing you are doing is an estimate. So if there are any adjustments you do, and the fact that you are doing the adjustment puts you into IAS, an adjustment on estimate will bring you into IAS 8, change in what? Estimate. So that is how you are, and those changes will be recognized in the profit or loss. All right, those changes that will happen will be recognized in the profit or loss. When we look at standard like IAS 8, I'll bring it up, and the standard like the IFRS 2, yeah, we will bring it up. Okay, so that is that. So basically, this is a discussive part of it. Talk about what net realizable value is, the fact that they can estimate it, and year on year, if there is any changes in the market, they have to be what? Making an adjustment, which contributes to changing what? Estimate, and therefore you must do the effect of the change. So let's say probably we had a net realizable value at a point of 2,000. There has been a change to, let's say, 1,800. Then this is what we pick. But the difference of this change of 200 will go to what? The SPL. All right. So there's like an impairment sort of thing in there. All right. So ladies and gentlemen, that's it. Go over it, understand the principle, and get more questions and try your hands on. Thank you very much, and God bless you.